It's a pleasure to be here, bright and early. It's slightly different than advertised. What we're going to talk about this morning is probably what I see as one of the bigger risks to the coal industry. And that risk comes from what I've called kind of the carbon and gas nexus. So that's the combination of an expansion of carbon pricing around the globe, increases in the level of carbon pricing, and then what's happening in global gas, which at the moment is beginning to go through what I would say is a fundamentally restructuring in which it's going to get much cheaper than it is now. So you're looking at a gas market that's poised for another significant move downwards. And when you get both of those together, then of course what you start having to do as a coal industry is not only do you have to worry about coal-on-coal competition, you have to worry about gas-on-coal competition in power. Okay, let's go into carbon pricing, domestic policies, everything. And the reason I say that is because emissions trading schemes come out of domestic policy. You do not look to the Paris Agreement as something which is going to be the introduction of global carbon pricing. That's not what Paris is about. Paris is about setting a framework in which countries will come together and say, this is what we're going to do in terms of mitigation of climate change and adaptation to climate change. This is how much we think it's going to cost. And these are the domestic policies we have in place to deliver this. So it doesn't rule out carbon pricing, but it doesn't introduce carbon pricing in any significant way. That's not what Paris is about or is going to do. So that's why I've said Paris changes nothing. Paris changes nothing in terms of the spread of global carbon pricing. What it does do is it sets a framework where you can monitor, report, and verify what each country is doing. And in time, and this is the point of Paris, is in time, you can then increase the pressure on individual countries to do more. And as you do that, that's when you expect to see additional domestic policies on emissions. And one of the key places that those policies are going to focus is the power sector and getting emissions down in power, which of course means using less coal. Now globally, when we look around the world, really the heart of emissions trading remains the EU with the EU emissions trading scheme. And we'll go through in quite a bit of detail this morning what we think's happened, why we're quite actually bullish on EU ETS prices. You do see some other places. We've highlighted North America there. Those are regional schemes. So you've got a regional scheme in California. You've got something called the Regional Greenhouse Gas Initiative in the Northeast. So really, the whole countries probably shouldn't be colored in. In Canada, you've got Alberta with just a carbon price. That's effectively a tax. And then in Quebec, you have an emissions trading scheme. There could be some expansion in North America on that regional basis. In Canada, you could possibly get, if you have a change in government, given the elections today and tomorrow, today I think, or yesterday, if that was to have a change in government, you could see Canada maybe move to emissions trading a little bit faster. Now, the only other place where you see a real movement, I guess, is in South Korea, which is colored in, and China. And China's quite important because China will have a national emissions trading scheme, probably starting 2017. It's got a number of regional ones in place at the moment, and we're kind of just beginning to see how that market might pan out. But again, you know, the issue there is really to focus on power, is what it's trying to focus on, those emissions trading schemes. And how that pans out, certainly in terms of that nexus of getting greater gas into the Chinese economy, that's certainly what it wants to do. Okay, moving on to the EU ETS. The EU ETS, those are EUA prices. So EUA, for those of you who don't know, the European Union allowance, that's what power generators price in when they make short-run marginal costs on how you use and what kind of fuels you use. And you can see that it kind of hit a low back here right at the beginning of 2013, about €3. But since then, it's been pretty much the only energy commodity that I can think of that's added any value. And it's consistently added value over the last couple of years to now be trading between 8 and 8.50. So it has gone up. Now, we'll go through why it's gone up, but you can see that we think that that's going to continue. So this is where we are at the moment. We've done this little V shape, and we think that's going to continue and keep going. The forward curve does that. I don't know if any of you follow this, but do any of you have a view on whether you think this is a better view of the future than that? It's just an interest curve, exactly. So thank you. Thank you. So those are our forecasts. That is a view on the future. And as you say, the way the emissions trading works is all you have is the only cost of carry going forward is the rate of interest. So it is in contango. It's always in contango at effectively the cost of money. Okay, why we're bullish on carbon is not so much to do with what I would say the demand side of the EUS picture, because the demand side doesn't remain great. This is a picture of industrial growth and industrial demand. So that's industrial production in Europe for some of the key energy-intensive sectors. You can see in 2008 the impact of the financial crisis and the fact that European industry has not really ever recovered from it significantly. It hasn't recovered to those past levels, and we don't expect it will. I mean, Europe at the moment suffers from both a lack of competitiveness in terms of unit labor costs, but it also suffers in terms of unit energy costs, so particularly when you compare it with North American energy. So it doesn't have any of those things going for it. It does look like emissions slightly went up between 2012 and 2013 on this picture. They didn't actually go up. It was an expansion of the types of gases and types of industrial gases captured by the ETS. It was a rule change between what was called the second phase of the ETS, which ended in 2012, and the third phase, which started in 2013. So that was just an expansion of the amount of emissions captured under the scheme as opposed to an actual increase in underlying emissions levels. Now, when we come to power, which is the other big sector covered in the EU ETS, you can see that, again, emissions, these are emissions again, verified emissions, big reduction in 13 and 14. Part of that was driven, I would say 14 was a very, very mild year, so we had very little in the way of, let's say, incremental power demand. We didn't have any incremental power demand, but not that much energy usage. But having said that, 2015's been a more normal year, and we'd say, you know, emissions might slightly go up, but it's not going to go up very much. It's not certainly getting back. And why is that? It's because over the last decade, I'd say Europe has been busy decarbonizing, increasingly decarbonizing its power generation system. You can see here these are net additions, net capacity changes, and you can see this huge amount of renewables that have gone on, lots of wind, lots of PV, a fair amount of gas-fired power generation's gone in as well, even though it hasn't been used very heavily yet. And then net reductions in the heavier emitting coal and fuel oil. So even though we haven't had very high carbon prices, it certainly has affected what's happened to capacity stock, and you've had very, very heavy subsidization in favor of renewables, and Europe's been very, very good at putting in renewables, and we look at that going ahead as probably about 20 gigawatts of renewables to keep coming in every year for the next 3 or 4 years. So that's going to continue as a process, even though you see some of those renewable subsidy programs being slightly softened or unwound. So why we're bullish is policy, effectively, and there was two. As those prices fell, there became a lot of pressure to say the ETS isn't doing enough in terms of domestic emission reductions. Now, the reason prices fell so much is there was a rule that allowed the EU ETS to use international offsets. So these are projects done around the world which were reducing emissions, and we imported an enormous amount of emission reductions. About 1.4 billion tons of emission reductions were imported from outside the EU and brought in under the scheme. So this tipped the market into oversupply, and there's a lot of inventory in the market, and so prices weren't doing anything. So some very big policy push to try and do something to get those prices higher and deal with that. And what the main two were something called backloading. So backloading is happening now, and that takes 900 million tons out of the auction volumes that are being sold to installations at the moment. So it's taking 900 million tons out of the market. And the idea was, well, they weren't quite sure what the idea was, but the legislation was, or the rules were, you were going to put it back into the market in 2019 and 2020. So that's why it was called backloading. You take it out of the front of the beginning, the front of this phase, and you put it back into the back of of the phase. But it became clear to policymakers and everyone in the market that what this meant is we'd start driving prices up, and then as soon as you got to the end of the phase, you're going to have to dump in 900 million tons of carbon, and this was going to push the price back down. So then they went through and said, well, okay, we need something more. We need something more, I'd say, more structural in the market to make sure we aren't always in oversupply and it tightens up the market. And this is called the Market Stability Reserve. And the Market Stability Reserve was agreed earlier this year. And with the MSR, the way it works is the regulator, the EC, kind of calculates how much inventory of carbon permits is sitting in the market. And then it says if that's above a threshold, we're going to take out a big chunk of that every year by reducing the amount we sell in the current or in the following year, right? So we'll make a calculation, and then we'll reduce the auction volumes in future years. So what that's going to do, and it starts working in 2019, you can see it's going to start with about 2 gigatons of surplus capacity. And this is just a hypothetical picture to show you how in theory, this works. And every year, what it will do is it will take out big chunks of carbon as you get closer and closer to this threshold. So it kind of said, well, we need maybe 800 million tons of carbon in the market for the market to provide forward hedges, effectively, right? So the market needs some inventory, which is somewhere between 800. And when it gets beyond that threshold, it stops taking carbon out. And then when it goes below a lower threshold, which is 400 million tons, and again, these are just rules that were kind of made up by policymakers and were kind of heavily debated, but that's what we ended up with, then it'll start putting carbon in and take it out of the Market Stability Reserve at the rate of 100 million tons a year. So the key thing is it takes it out quickly and then puts it back much slower. So that tightens up the market and tightens up the market and tightens up the market. And what we think that does to market-held inventory is you can see at the very peak or at the very trough of prices, we had about 2.3 gigatons of surplus EUAs. And we think what the combination of this does is it drives that inventory down. Now, we do think the market needs inventory because the way it provides hedges for the utilities, and the utilities like to hedge 2 years in advance a lot of their power, and they buy the carbon to hold on the back of that. You need this inventory in the market to help the market provide those hedges. And so what we see is if you look at the demand for hedges and the supply of that inventory, you get closer and closer to the place where you start getting into not having enough inventory in the market to provide those hedges. Then what you need to do is get into some form of short-run abatement. That short-run abatement tends to be fuel switching in power, okay? That is, you get gas-fired plants operating rather than coal-fired plants, because coal-fired generation generally has 2 to 3 times more emissions than a gas plant, right? So you get a big reduction in emissions just from swapping the coal to gas. So we're very, very bullish on that basis that increase in prices is going to continue. So that's the carbon story. Now when we look at the gas story, well, you can already see what's happened to global gas. And this is a really exciting market because it is really just beginning to become a global gas market. It never really has been that. It's just been a series of regional markets that never talk to each other. But you can see that there's been a big convergence between Northeast Asian prices and European prices. Now, these are North American prices down here, North American shale gas. That's been very low. And there hasn't been any real convergence because there's been no way for the US to export gas. Well, all of that changes in the next couple of months with the very first LNG facility at Sabine Pass, which is going to start putting in gas onto the water come, well, either the end of December or the beginning of January. So you can see this huge convergence. And when you look at it, you have to say, well, what's driving that convergence? The supply is driving that convergence. And there's just a massive, massive waves of LNG plants that are under construction that we know about that are coming into the market. And the first wave is Australian LNG. These are all Australian projects. You can see 2014. Quite a bit that was going to come in kind of 2015, 2016. Most of it's in by the end of 2017. And then that's matched by a second wave, which is North American US gas. And most of that's coming in kind of 2018, 2019, 2020. But when you look at it on a quarterly basis, this is the march up of capacity. And we, at the moment, are here. And we're at less than $7 gas, right? So it's come down from those really high prices, which were up at 15, 16. It's at 7, and we're here. And this is what we're going to go through in the coming quarters of supply capacity additions. And that 120 million plus tons per year is coming into a market of around 400 million tons per annum, right? So it's incredibly swelling the size of the seaborne gas traded market. And it's going to tie global gas together in a way that's never happened before. And of course, there's a demand side. There's always a demand side. And there's a number of, but that demand side, those red bars, if you just stack up all the kind of liquefaction against what we think just in terms of quarter-on-quarter changes, you can see liquefaction is far outpacing the increase in regasification. So i.e. the supply side's growing much faster, but regas generally has fairly low utilization. So what this means is higher utilization of existing regas. And the only way to get that is to get the demand side. And the only place you're going to get that demand side quickly is in power. And the only way to do that is to display, in the short term, is to displace coal. Okay, so where's it growing? Well, China's adding a bunch of regas. Japan and South Korea are adding a little bit of capacity, weirdly, but we don't actually think they have a good demand story. We think they have a very bad demand story, both of those countries, because they're adding nuclear. Every time you add nuclear, you tend to displace LNG. You're certainly displacing thermal, but you probably displace LNG. India's adding capacity, has an okay demand story, but generally, LNG has been too expensive for it to use. So it has to get very, very cheap to get it into the Indian mix. Europe isn't adding that much capacity, but the existing capacity is hardly being used. So there's an immense amount of additional regas capacity that's going to go in. And as you can see, gas demand hasn't really been growing, certainly not at a rate, globally at a rate, that's going to absorb that type of gas, that volume of gas. So the only way to do it is to get more demand and get faster demand. So where's it going to go? Well, a lot of it's going to go into Europe. So we think Europe's going to be, Europe at the moment is the residual taker of LNG. So the amount of residual LNG that's going to go into the market is going to go here. And you can see that this was the level of 2014 imports against the level of regasification capacity in Europe. So Europe has a huge amount, even just Northwest Europe, has a huge amount of capacity just to take in more gas. And we don't need it because we have lots and lots of pipelines, right? So we have lots of pipeline gas. We don't really need LNG. We don't call it over to us. We just take it because there's a hub there and you can sell it into the hub. And then the price does the work to start getting gas, to get enough demand, right? And there's a lot of fuel switching capacity. So this is how much we think each of these different regions can take just if you got more gas into power, okay? So if you get more gas into power, these high levels, you can have an immediate increase in gas demand. But you need gas into power. So you need two things to happen. You need carbon to be more expensive, and you need gas to be cheaper. And when we look at it, and this is a schematic of the global gas market, and you say, well, how does this market balance if you've only got maybe Europe, which can take stuff, maybe India, which has a bit of a demand story, or China, which has a demand story, when you're adding these huge, huge blobs of capacity, of supply capacity? Well, I think the first way it balances is you say to this big stuff, which is Qatari gas, you no longer go into Northeastern Europe. Qatari spot gets pushed out of Northeastern Europe because all this Australian stuff is really going to own the Asian market. The Pacific market is going to really be owned by the Australians, right? All of that capacity comes in first. It washes in. Says Qatari gas, you no longer go there. The Qataris then start looking west. They start looking to Europe and start dumping it in. Now, when this stuff starts coming in, there's a limit to how much the Europeans can take. But you'd also say the next thing it has to do is again, because the Australians are really bossing that, it says, well, actually, we're not going to send very much North American gas to Asia, right? That's just going to be Australia. Australia is going to fill that as long as it can, and we're going to just not move that. And then the next way it's going to balance, if the Europeans, because again, the North Americans and focus their impact on the Europeans, the other way to do it is then to say, at some point, we close that arb, and the North American stuff doesn't go to Europe either. So where does the North American stuff go? Well, nowhere. It stays in North America. North America has a huge gas market, right? So it's just going to stay in North America. But the interesting thing in terms of price implications is this drives the world to price on Henry Hub. This is the big change, right? So Qatari spot's pushed out of Asia. What does that mean? It means Northeast Asia has to go to a discount to European hubs, the MBP. It has to go to a discount, or gas will keep flowing, right? So that's the first thing that happens. Second thing, North America's pushed out of Europe. So Northeast Asia becomes no more than Henry Hub plus the cost of transportation into Asia. But if you got to go through the third level and say, well, actually, you're pushing North American gas out of Europe, that means it's going to be European gas has to be no more than Henry Hub plus the cost of transportation, which is only about 50 cents, right? Well, if you've got the first one, this also means Northeast Asian gas has to be no more than 50 cents above Henry Hub. So what you have is you have global gas going down to those low levels of North American gas. Of course, if you're exporting huge amounts of gas from North America, that is going to push up those levels of Henry Hub. We think is only going to push it up from like current prices of $3 to about $4. So you're looking at a global gas market that's going to converge around $4 by the time you get to the end of this decade, and it's probably going to happen faster than that. We think it's probably going to happen by 2017, 2018. You are going to get global gas pricing on low global gas world. So what does this mean? Well, in terms of fuel switching, what it means, and we've just looked at the UK Q116, but certainly we've done this for other markets as well, is at current coal prices, what it kind of means is as you move down in terms of pence per therm, you get more and more gas. So at the moment, you'd say you're around here, you're using about 5 BCM of gas during the winter time at 45p. But as you go through, and if you've got $50 coal, certainly that slows down your fuel switching. But if coal was to get expensive, you could get going from about 5 to just about 10, so another 5 BCM of gas in a very short period, right? And you could do that at prices around 30p, which is around $4 maybe. Yeah, $4.50, something like that. So if you're looking at Henry Hub, it being $4.50, it's going to be on that fuel switching nexus. And what does that mean for implied carbon? Well, as you get cheaper and cheaper gas, the implied carbon you need to get fuel switching away from coal falls. So this is for different coal prices, and you can see as coal gets more expensive, of course, you get fuel switching faster. But at $50 coal, if coal doesn't go anywhere, if you get 30p gas, then at about 12 euros per ton, you're going to get a lot of fuel switching, even in continental Europe, right? So you even get it in continental Europe, and that's how this global gas market is going to balance, and that's why I think we see this combination of the expansion of global carbon pricing and the big changes being seen in global gas as being fundamentally bearish what's going to happen to the global coal market. And that's about it. So I think I've run through